Now let's look at the performance comparison. First, we look at the annual return between a market index and the SI index. As you can see from the left, the SI index did not always outperform the market index over the last 20 years, but when the market is suffering from the financial downturn, that SI index will be able to perform better. Uh, and if we look at the table on the right, we can see that the SI index has the lowest level of volatility compared to the market index, which indicates that the SI index is much safer than the market. And if we look at the average returns of the four indexes, and we can see that the SI index completely outperformed the three other market indexes over the 10, 15, and 20 years, and with the lowest volatility. And this is another view to look at the return and risk of the index. And here we plot the data of 10 years average return and volatility in the average return and volatility space. And you can see that the upper left corner is the best, which means higher return, lower risk. And here you can see SI index has the highest average return for the least amount of risk. And here is the attempt to demonstrate that why modern portfolio theory does not hold true. Because I used the market to construct a efficient frontier, and either with or without risk-free assets. And as you can see, the modern portfolio theory return is less than the super invested index for a given amount of risk. So again, it suggests that the modern portfolio theory does not hold true. So when we look at the 5-year rolling returns comparison between the four indexes, we can see that before 2000, the SI index did not outperform the market index, but after that, it outperformed the market index. Surprisingly, the Russell 2000 has the lowest volatility in terms of the 5 years rolling return. I don't know the reason exactly, but my guess will be during the economic downturn, the money goes to the large cap companies, so there were not a lot of transactions in the small cap companies, so the stock price was not fluctuate as usual. So that could be a reason why the Russell 2000 has the lowest volatility. And if we look at the 10-year rolling returns, it is very clear that SI index outperformed the three market indexes over the last 20 years. And if we look at the cumulative return, we can see again after 2000, the cumulative return of the SI index goes way up high compared to the market index. That was because the compounding effect, because the money they saved during the economic downturn and gets compounded and eventually contribute to this over 900% cumulative return over the last 20 years. And again, SI index has the lowest level of volatility. So after the comparison, you may ask, oh, how do they achieve such amazing performance? And here I use this quote from Seth Klarman, who's also a very famous, successful value investor. He said, value investing requires a great deal of hard work, usually strict discipline, and a long-term investment horizon. So for value investors, they need to perform a fundamental analysis, and which requires a great deal of hard work, and they need to discipline themselves to follow the margin of safety rule and also be long-term instead of short-term. And they need to have patience and also they need to believe in themselves to see the appreciation of their investment. So that's the main reason why they have such amazing achievement. Some personal views. First, I want to thank you for this opportunity. It is a very unique experience and it significantly adds to my knowledge of value investing. And second, would I invest my parents' money? My answer is not now. Because during the preparation of this presentation, I realized that value investing is easier said than done. So right now, I will not invest my parents' money, but eventually I will. And would I invest with super investors? My answer is yes. I know super investors do not believe in modern portfolio theory, but here I just use that to calculate the proportion invested with them if I do invest with super investors. If we look at the risk-free return, we can see right now is the good time to invest with super investors because given a lower risk-free rate, you will be able to generate a higher Sharpe ratio. So Sharpe ratio is a measurement. Basically, it measures whether a return of the portfolio was due to the smart investment or that was due to the excess risk. So in short, right now it's a good time to invest with super investors. And yes, I will invest with them. And in conclusion, again, I use the quote from Seth Klarman to summarize this presentation. I want to focus on the person, not the mechanism of the market. So they need to perform an in-depth fundamental analysis, and they need to be long-term horizon, and they need to have strictly discipline in order to be successful. So thank you. Goodbye.